Hi everyone, my name is Mike Shuman. I'm with Vermont VA Federal Credit Union, and this is our first episode of Show Me the Money, with apologies to Cuba Gooding Jr. This is a personal finance show to give you best practices and some financial education about what is going on in the world, how to improve your financial lives, and today's first episode is going to involve FICO credit scoring. We call it We're Talking FICO. And after that, we'll get into some discussion about we're talking mortgages and we're talking car loans. So ultimately, Vermont VA Federal Credit Union is your financial resource who, if you ever need a mortgage or if you ever need a car loan, and that's to purchase a used car, a new car, maybe even refinance a car. And just to let you know what a credit union is, because a lot of people don't know what a credit union is. A credit union is a nonprofit financial cooperative. Here in Hartford, there's actually, in White River Junction, there's actually a food cooperative, very common, where people become members and they get food at a discounted price. Well, it's not unlike that, except you put $5 into a savings account and you become a member of a financial cooperative. And we offer really good rates for savings accounts and checking accounts and money markets, but also for loans. What we try to do is we try to put the credit in credit union. And when we had difficulties a few years ago in the financial crisis, some banks were reluctant to lend money. Well, the great thing is credit unions were very consistent in their lending standards, and they tried to help and didn't cause any problems in the economy, and ultimately helped a lot of people who were trying to buy a car, buy a home, or what have you, and got frustrated by alternatives to credit unions. So that's what we do. And if you're interested, if you live, work, worship, attend school in either Windsor or Orange County in Vermont, or at Grafton or Sullivan County in New Hampshire, you are eligible to join. Or even if you have a family member that lives in any of those counties, you're eligible to join our credit union. And so it's one of the best kept secrets out there in financial services, and that's another reason why we're here. We want to get the word out that credit unions are great, save you some money. If you've purchased a car at a dealer and they gave you a high rate, come to us. We are big on refinancing cars to help people save money. I would rather have it in your pocket than some stranger that you send a check out to in Texas or California. So this is the Green Mountain State. Let's save you some green, and that's the idea. As I mentioned, the first segment is We're Talking FICO. What is FICO? FICO is actually kind of an acronym for Fair Isaac Company. And Fair Isaac Company has a model on credit scoring. So there are certain inputs, as they say, garbage in, garbage out. So these inputs determine your score. So they have a model that is proprietary. So they don't tell you exactly the details of their credit scoring model. What they do is they give us a rough idea. And a lot of this information is out on the web as well. But a lot of people, they don't necessarily know, and so this is just good information. So that's why we like to talk about We're Talking FICO. Now, just to let you know, within the model itself, and what this does is it can impact not whether you get a car loan or a credit card or a mortgage or what have you, but what it does is it can determine your rate. So you want to have the highest credit score possible. Credit scoring goes from a number of 300, which I've never seen 300, to 850. I've never seen an 850, so that in theory is what it goes to. However, I've seen an 841. I've seen low 400s. It's very difficult to get credit if you have credit in low 400s, and I'll explain why in a moment. And if you're at 841, the world is your oyster. You're more likely to get credit and at a much lower rate. But also other things impact your credit scores. The determinant of your credit score can also determine your insurance rates in many states. It can also determine whether you get employment, because a lot of employers nowadays are checking your credit, not checking your score. So it's important information in general. And as I found out very recently, 1 in 10 Americans of adult age don't have a credit score. Now, certainly when you're 18 years old, you're unlikely to have a credit score. But when you hit 24, 25, 26 or older, you want to get into the credit market. You don't abuse credit, obviously, because that doesn't help you, and it certainly doesn't help the lender. It doesn't help you long term, because you want to be able to have access to credit. Because at one point in time, maybe you want to buy a house, you want to buy a car, you want to start a business. It's helpful. You really need to have the highest credit score possible to gain access to credit. Doesn't determine whether you get it or not. There are other factors as well, but it gives you the lowest rate possible. So it's easy to service your debt. So just a few things. The most basic premise about credit scoring is to use credit wisely and sparingly. And this is how it works, wisely and sparingly. 35% of your credit score is determined by your payment history. So that's more than a third right there. So if you're paying on time, everything on time, your score is going to be better than it otherwise would be. So that's just a starting point, however. 30% of your credit score is determined by what they call your balance to limit ratio, predominantly on credit card and revolving credit accounts. What does that mean? That essentially means you want to keep your balances low and your limits high, because your balance to limit ratio will determine 30% of your score. So if you have high limits and you have low balances, your score, and you're paying on time, that's 2/3, that's 65%, almost 2/3 of your credit score. So you want to pay on time, keep your balances low. So as an example, if you want to close a credit card, recommend against it generally because that condenses your limits. You want to keep your limits high because, as an example, let's say you have 10,000 at all limits in all revolving credit. So that includes credit cards, home equity lines of credit, overdraft protection, etc. Let's say you have $10,000 out there and you have $5,000 in balances. That means you have a 50% balance to limit ratio. Say you close out a $5,000 credit card. All of a sudden, you have a limit that equals your balances. You're at 100% balance to limit ratio, which means you have zero available credit, which means your score is going to plummet. Now, a general rule of thumb is try to keep those cards open. If you need to open up a different card because a credit card issuer is charging an annual fee, I understand that wholeheartedly. Get a replacement card, go to credit union, preferably ours, but others are available as well. Credit unions, once again, financial cooperative that gives you the best deals out there. So what you want to do is try to keep those balances low. Try to keep those limits high. Don't close out accounts. Pay on time. So once again, using credit wisely and sparingly are the keys. Now, what about the other 35% you may be asking? Well, these are legitimate questions. So as an example, when you open up new accounts, and what will happen is someone will pull credit on you. That's an inquiry. An inquiry is not a big deal unless you've had relatively new credit. It's generally a 3 to 5 point hit in your credit score. A lot of people are concerned about that. I don't want to have people pull an inquiry, a lender pull an inquiry, because it's going to hurt my credit. It's a minor issue. If you're not paying things on time, that's going to have a much bigger deal as far as your credit score. So you obviously want to, once again, wisely and sparingly. You don't want to apply for credit unless you absolutely need to. One other thing that has been changed in the model recently is if you apply for the same type of credit within, let's say, a 2 to 3 week time frame, it only counts as one inquiry. So as an example, you're looking to buy a car and you go to a whole bunch of dealers and they all pull credit on you, but you do it within a condensed time frame of a couple weeks, let's say. It only counts as one inquiry. So that's not too bad. It's just the first inquiry. But if you do it every month for a number of months, then it's going to count as multiple inquiries. So you want to do it within a short period of time. So that's one of the things that impacts your credit. Probably about 15% between the inquiry and the new line of credit that's on your credit report. Over time heals all wounds in credit. So if you've been late on something, if it's more than 2 years old, it becomes less of an issue. But you want to pay everything on time. And when you have a new line of credit, that inquiry becomes less important. That line of credit becomes less important. So these are important aspects of what we do. The next thing that is on the agenda as far as credit scoring is probably about 10% is how long you've had credit. Now, if you've had credit for a short period of time, you're in the process of establishing credit. And it's not like there's a fine line of demarcation. Well, I've had credit for 2 years and I've established credit. It doesn't work that way. It's a process, it's a long-term thing. And it's probably, for many people, if they're going to be in the credit market for their lives, it's a lifetime thing. So you want to keep your credit score as high as possible, once again, not only because you want to have access to credit and lower rates, because it can impact your insurance rates and your costs there, and also your capacity and your ability to get employment. So that's important as well. But if you have credit for a couple of years, you're starting that process and it keeps going. If you've had credit for 20, 25, 30 years, well, you've probably established credit at that point in time, and hopefully it's a good credit history. And once again, you're using credit wisely and sparingly, only when you absolutely need it. So then you're going to be in good shape. You'll probably, at all things being equal, you'll have a higher credit score than someone who is just starting out And oftentimes they'll get a little credit card, and oftentimes they'll use it and sometimes max it out. So that hurts their balance to limit ratio and the amount of time that they have, etc. So those are some of the key concepts of credit scoring. I want to make sure I haven't missed anything here. New credit is actually 10%. Length of credit history is actually 15%. So I want to make sure we have that absolutely correct. And our friends at Fair Isaac give me all these updates. Oh, here's an interesting one, 10%. 10% of credit scoring is determined by the type of credit you use. A lot of people think credit means credit cards. The reality is credit could be a mix. And in this case, the mix that you have can determine your credit score. So as an example, let's say I only have revolving credit, home equity line, credit card, overdraft, things like that, but I have no installment loans. I have no car loan, or I have no mortgage, regular mortgage payment, etc. That would hurt me on my score, but only 10% of the impact. But if I have a mix, let's say I've got a car loan, let's say I've got a mortgage, let's say I have credit card or home equity line, don't take out too much, but ultimately I've got a mix of, say, 2 of one type installment and 2 of another type revolving. Overall, that mix is going to be perceived by the credit scoring model positively. But if I'm leaning one side or the other, I have no credit cards and I have all installment, or I have no installment and all revolving, that's not a big hit on your credit score, but it can have an impact. So once again, the general premise is use credit wisely and use credit sparingly. So that's what we're talking about. So remember, make sure you keep your balances low as much as you possibly can revolving. Pay on time, pay on time, pay on time, pay on time. If you have access to a checking account with online bill pay, that's the best way of doing it, because you can pay a lot of creditors through online bill pay, save money on a stamp. A lot of them get paid electronically. Some mortgage lenders take it that way electronically, or credit card issuers. And ultimately, that's a good way to keep your credit score up and to make sure your cash flow is under control. The money comes in, and you have the money go out certainly in a timely manner, so you're not late with your credit card payment or any other payments that you have. So just to let you know, some of the things that are not in your FICO score. Your race, color, religion, national origin, sex, and marital status are not in there. Your age, your salary, occupation, title, employer, date employed, or employment history, where you live, any interest rate being charged on a particular credit card or any other type of account, any items reported to a child family support obligations. Certain type of inquiries are not on your credit report. Consumer issue. Your score, as an example, is not going to be impacted if you pull a credit report from what we call annualcreditreport.com. You're entitled to 1 free credit report per year. So the idea is that you go to annualcreditreport.com. That's what's called a soft pull. Pulling your credit doesn't impact your score. That type of inquiry does not impact your score whatsoever. If you come to a lender like Vermont VA Federal Credit Union, then it would have an impact on your score. Once again, 3 to 5 points is the normal range for that. Any information not found in your credit report will not hurt your score. Any information that is not proven to be predictive of future credit performance, whether or not participating in a credit counseling of any kind. A lot of people work through past debt problems through a credit counseling firm, which is a good thing. National Federation of Credit Counseling is the umbrella organization, and if you're working with somebody who's with the NFCC, that's a good thing, and you want to get yourself together. So once again, you're going to open the doors. This is about opening doors. It is about getting to, as we like to say in the credit union world, getting to yes. We love getting to yes to help people. And if we can help today, great. And if we can help at some point in the future, because we're helping you now get it through these problems, a credit counselor can do that as well. That's certainly helpful. So 3 things you can do right now. Check your credit report, annualcreditreport.com. That will not give you a score, but if you want to pay for it, you certainly can do that, and I believe it's around $16 or $17 per bureau. There are 3 bureaus, TransUnion, Experian, and Equifax. Those are the 3. If you want to do it through one, that's fine. That's certainly your call. Get a rough idea of where it is. Set up payment reminders, always a good thing. Once again, go online, check to see where you are for your credit card, when does it close, when does the bill due, et cetera, but use online bill pay. That's certainly helpful. Make it easy. Make it easier for yourself. Make it a game. That's helpful too. Reduce the amount of debt you owe. Once again, balance to limit ratio, and to keep your balances low and your limits high. Try not to close out accounts unless they have annual fees. Then have a replacement card or what have you before you close out the other account. Replacement card meaning no annual fee on that credit card. Other tips, as mentioned, pay your bills on time. If you've missed payments, get current, stay current. Be aware that paying off a collection account will not remove it from your credit report. It'll stay there, it may say paid collection, or if you settle an account, it'll say settled. Be aware that paying off a collection account, as I mentioned, if you're having trouble making ends meet, contact your creditors or see a legitimate credit counselor through NFCC. Check out their website, do a Google search for that. If you've been managing credit for a short time, don't open a lot of new accounts. You want to, once again, it's a process as you're trying to establish credit. Okay, you want to keep your balances low, pay off debt rather than moving it around. Don't close on the used credit cards. These are all tips from Fair Isaac. Do your rate shopping for a short period of time. So a lot of these things are repeated ultimately. But the bottom line is, if you do as I have mentioned, because I've been in the business for a long time, then you're going to do well. Now, how credit scoring helps me. People can get loans faster. Credit decisions are fairer. Credit mistakes count for less. More credit is available to you. Credit rates are lower overall the higher score you have. There are credit score facts and fallacies. A score determines whether I get credit. As I mentioned before, it does not determine it, but it can certainly help you. If you have a higher score, lenders will do what they can to try to help you out. A poor score will haunt me forever. It's not true. It's a dynamic thing. Every month, your score actually changes on each of the credit report bureaus. So it does. Don't be fatalistic. Work with a credit counselor if you're having problems. And if you're doing great, keep it going. Keep doing the good work. Credit scoring is unfair to minorities. Once again, it doesn't necessarily know, as far as the credit scoring model is concerned, the race of the individual, the gender, etc. Credit scoring infringes on my privacy. Credit scoring evaluates the same information lenders already look at, so that's really no distinction. A score will drop if I apply for new credit. Once again, 3 to 5 point hit, so it's no big deal. So once again, 1 in 10 Americans don't have credit, or they don't have a credit score. And a lot of people are afraid. I understand that. So if you want to get into the credit market, come to your credit union and open up a credit card or a small loan, maybe a savings secured loan. That can certainly help. Now, just to let you know, we're talking FICO, and we're going to talk a little bit about mortgages and a little bit about car loans as well. But we're going to have future episodes, and I would love to have your help. So if you could email me questions, that would be great, and I'll get your question on the air. And my email address is Mike, M-I-K-E, at vtvafcu.com. Mike at vtvafcu.com. And I look forward to getting your emails and your questions, and I'll be able to respond to you on the air, and we're going to have a good time with that. We're going to get into segment 2 in just a moment. Welcome back. We were just talking Fair Isaac Company, FICO. We're talking FICO credit scoring just a moment ago. Now I want to talk about mortgages. Well, unless you have a lot of money where you can put an entire cash down payment without any mortgage on buying a property, that would be a wonderful thing, but that's also unrealistic for a lot of people because the price of housing can be very high, and it's a real challenge. Most people, when they buy their first home especially, they do get a mortgage. They have to put some money down, or sometimes they can get away without any mortgage down payment at all. How can they do that? First of all, as I mentioned in credits, we're talking FICO, you need to have a really, really high credit score in order to get a no or low down payment mortgage. What am I talking about? The U.S. Department of Agriculture, the USDA, offers a no money down mortgage, which we offer at Vermont VA Federal Credit Union. VA, if you are a veteran. We love to help veterans. That is our history with the Vermont VA Hospital. But we love to help veterans get into a home, and that's no money down. So that can be really helpful to get you on your way. And also, we have FHA programs, Federal Housing Administration. So if you only have a small down payment, 3.5%, what does that mean? Well, if you've got a $200,000 property, you've got $7,000 saved. You know what? You might be able to get a mortgage, even if you're not a vet. You can get an FHA mortgage conceivably. You could possibly get a USDA mortgage without any money down, which is nice. And if you are a vet, VA. Now, if none of those really apply to you, just want to get a conventional mortgage or what we call a jumbo. A jumbo mortgage is anything over $417,000 for a mortgage loan. That's a large loan. In that circumstance, you're likely to put down 10% or more, and oftentimes people don't start with those types of mortgages with a jumbo in this area of the world. What they do is they generally will go with a conforming less than 417. You put 3.5 or 5 or 10% down, you're going to be fine. If you want to get a jumbo mortgage, anything over $417,000 on a mortgage, you're going to have to put down 10, 15, 20%. And once again, one thing that can determine the flexibility for a lender is your credit, the quality of your credit score. We also look at what's called your debt-to-income ratio and your employment debt-to-income ratio. Look at all your obligations divided by your income. So we're going to look at the principal, interest, taxes, insurance, and if you put less than 20% down, you're going to have to get what's known as mortgage insurance, which you pay for, but it protects the lender. You add up principal, interest, tax, and insurance, and if necessary, mortgage insurance, and if necessary, condo fee, if that's applicable, and all your other debts, your car loans, your monthly payments on credit cards, your personal loans, student loans, any other obligations, child support, alimony, anything that you have as an obligation. Add all those things up. Divide it by your gross monthly income. You do that, that is your debt-to-income ratio. Now, if it's hanging around 50, 60%, it's difficult to get a mortgage, without question, for most lenders. But let's put an example out there. Let's say you make $5,000 a month. You and your spouse or your significant other, whomever, you make $5,000 a month, okay? Let's say you have a mortgage payment, proposed mortgage payment, total payment of $2,000 a month. Well, right off the top, 40% of your income is going towards that mortgage payment. And then on top of that, if you have a car loan and personal loan, credit cards, well, the point is you want to try to keep it, ideally, that debt-to-income ratio to 45% or less. That is the ideal situation. Now, we live in a market where it's economically and in the area where it's difficult, and it's also variable based on your neighborhood where you live. But the idea is that you want to try to get the best price possible. Work with a good realtor, someone who's looking out for your best interest, obviously, and try to get, some things on for $200,000. Market is not great, let's say. Try to bring it down. You can negotiate some, bring it down to a reasonable price, and also you can have a reasonable payment. That's important to you, but also eventually you may want to sell that property. And if you get it at a reasonable price, when you sell it, it's easier to make money off of that. So that's the general idea. So far we've been talking FICO, we're talking mortgages, and if you have any questions, or once again, comments, concerns, but questions on this or for future episodes, my email address at the Vermont VA Federal Credit Union is Mike, M-I-K-E, at vtvafcu.com. Welcome back. So far we've been talking about, we're talking FICO, credit scoring, we're talking mortgages, and I hope you found that to be helpful. And now we're going to talk car loans. Once again, credit unions have some core products. Credit unions often came about because people didn't have access to credit, so they wanted to have access to credit, but also to savings. So there was a good opportunity through their employer. They're able to save. And actually, that's a nice perk that we offer through a lot of employers, having a credit union as a free benefit. So it's free for the company. So if you're interested, let me know, and we can certainly add you as an affiliate. But the idea is that car loans have historically been a core product to help our members. Once again, when you join a credit union, you're a member owner. So $5 into a savings account, you're a member owner, which is nice. That's why it's a cooperative, so you can actually get the benefit of that membership. Having said that, what happens generally speaking, and I'll give you a good example. I know of one credit union that came about just after World War II, and it was predominantly nurses, predominantly women nurses after World War II. And they started moving into suburbs of a major city, and they needed access to the city, so they needed cars, they needed car loans. They would go to a bank, local bank, back in the 50s, this is before a lot of the discrimination laws came about, and almost invariably they were told, where's your husband, or whatever they may have been told. So instead of getting mad, these women were very smart, very well educated. They got even by starting a credit union. And from there, the largest preponderance of loans that were out there were car loans. so that these women could get to work. Very fundamental. People need to get to work. They need to get home. They need to go to doctor's appointments. They have obligations. So it's a big part of what we do for new cars, used cars, as well as refinancing existing. And we also do, motorcycle loans as well. We do RVs, we do boat loans, we do a whole bunch of other loans. We've expanded beyond just our core, but we really love, that's kind of where we came from, is car loans. So when you go to the dealer, similar to a mortgage, when you're negotiating on a house, what you want to do is get the best deal possible. So you're negotiating with the car dealer, and we know how painful that can be, but go in knowing what kind of car you want. Go to kbb.com, which is Kelley Blue Book, or go to nada.com in advance. You know what kind of car you want. Find out what their cost is. Find out what the incentives are, because if you can get the lowest price possible and as much incentives as you can possibly get, you're going to keep your monthly payment as low as possible. And when a dealer asks you, what payment do you feel comfortable with? Please try not to answer that question, because what will happen is, and what's happening now is, the dealer will do anything. They will move heaven and earth to make sure you got that payment, even if you get an 84-month car loan. That's a 7-year car loan. Do you want to hold on to a car? The new car's smell goes away pretty quickly. If you're going to hold on to a car for 7 years, you're going to have some difficulty at some point getting rid of it, trading it in. You could be what's known as upside down, meaning that you owe more than the car is actually worth. And that's a very bad situation to be in. You don't want to put yourself in that situation. So use a financial calculator, and this is for mortgages or car loans. My personal favorite, and I am not making this up, is dinkytown.com, dinkytown.com. And they have all kinds of financial calculators for our payments and retirement and so on and so forth. So there are a variety of resources that can help you. But go in, do your homework first so you get the best deal possible. And when you walk out of the car dealer, you're paying less than you had ever hoped. Even if you're comfortable with $300 a month car payment, don't say it. Please don't say you're going to save yourself more money if you don't, and over the long haul, if you don't answer that question. You just say, well, we're trying to get the best deal possible. You keep your price, you try to keep the price as low as possible, the incentives as high as possible. And when you are done negotiating with the car dealer, the car salesman, and their manager, so on and so forth, you think you're done, but they're not done. They're going to send you to the finance and insurance guy, the F&I guy, who are amongst the most highly compensated people at a car dealership, which can be fair. And but what they're trying to do is they're trying to sell you the financing, okay, and they get paid for that. If you get it through the dealer, it's a convenience for you. If they sell you gap insurance, which at your credit union it costs $275 for a nice product. At the dealers, they tend to cost, I've seen $500, $600, $700. That's a lot of money. Extended warranties, that can get expensive. I've seen those as high as $2,500 or $3,000 dealers, whereas your credit union can offer to you usually the discounted rate of $1,000 to $1,500, depending on the car you have. If you have a Chevy Impala, it's probably going to be less expensive than a Ford Explorer, four-wheel drive, turbo, because the turbo makes it more expensive, the four-wheel drive makes it more expensive, hybrids, I mean those things that make it a warranty more expensive. And they're trying to sell you other insurance products. And the F&I people, the finance and insurance people, very nice people, but they want to make a living, and they're entitled to that. However, that doesn't necessarily mean that you have to go in not knowing that they get an incentive for every single warranty, gap insurance, financing that they offer and they sell to you. So just go in knowing that this is a scenario for you. Oftentimes we have people come into us, they can get pre-approvals for their car loan, and they go to the dealer and they say, I want to go through my credit union. Sometimes they do and sometimes they don't. Oftentimes they come back to us to refinance it because they don't know who the lender is out in California or Texas or Montana, wherever they might be. So these are just some good tips to help you out. And we're hoping that we're talking FICO helped you. We're hoping that we're talking mortgages helped you, which, by the way, you can get a pre-approval for a mortgage, too, from your credit union on our website, vtvafcu.com. And also, we're talking car loans. Once again, we're going to make this a regular thing, and we want your questions, comments, concerns at mike@vtvafcu.com. I thank you very much for your time. And hopefully this is going to help anyone and everyone who's watching this show. Thank you.